check the big board because we've fallen some more. Again, I don't have a specific reason why we've had this turnaround. No, it's not you, David Stockman. It's not you. We're down 150. We opened with a gain of 110. So we've had a 260, 270 point swing in an hour. How about that? The big tech names, well, they're not doing much. They're mostly higher. The only one that's lower is Google. So you've got Facebook, Amazon, Apple, and Microsoft slightly to the upside. Got it. Now, we've clearly had unprecedented economic growth. The markets have hit a series of records. And we've got record profits for American corporations. And by the way, the low-tax states are seeing just extraordinary numbers of new jobs created, Florida and Texas in particular. David Stockman is back with us, former Reagan budget director and perpetual stock market bear, are you not?
It's not a bear. I'm a bear on what the Fed is doing, what Washington is doing, and the collision that's coming right in front of our eyes.
Okay, but look.
But it's important to get this out, that this month the Fed has pivoted to QT, huge, on all fours for the first time in history. $600 billion. They're going to be draining out of the bond market. They've ordered up a crash, and it will be a doozy. It's not the interest rate going up, 25 basis points that Trump is whining about. It's the QT, because all the central banks in the world are going to follow. Europe is out of business. They're not buying bonds anymore after December. So China is going to have to be selling bonds, not buying them, to support its currency.
So, let's forget about the 4 or 3% economic growth rate. Forget about profits. Forget about the stock market rally. You're looking forward and you're saying that the Federal Reserve has made a fundamental shift and is taking enormous amounts of money out of the economy.
Is that
accurate?
Accurate. And
so how are they taking all this money out of the economy? How do they do that?
They're simply allowing their balance sheet, which reached $4.5 trillion, to shrink by not reinvesting when Treasury bonds mature. And that's the same thing as selling bonds. And it's happening at the worst possible time when Washington has lost its fiscal sanity. It's going to be borrowing $1.2 trillion this year, in the year we're in. I'm not talking about the distant future. So now think about this. Treasury sells $1.2 trillion in new bonds. The Fed dumps $600 billion of old bonds. I do the math. It's $1.8 trillion of homeless debt looking for a home in the bond pits. Now, it will find a home, but not at 3.2% yield on the 10-year. It's going to 4.5%. And I don't think this market can stand a real, honest interest rate of 4.5%, or even higher. That's
your point.
That's my point.
The Fed takes money out of the economy.
And the Treasury dumps bonds in.
We still have to borrow $1.8 trillion,
right.
Which means interest rates go up because you've got to attract lenders to this.
And markets always clear. It's not like the thing is going to go tilt and, all the lights are going to start flashing. The market will clear at higher and higher yields. But the problem is we're now built in the 11th year of a business expansion. We're 6 months from an all-time record, and we have a deficit that's 6% of GDP. This is unheard of. In 2000, when we had this situation, the budget was in surplus, and even in 2008, it was a minor deficit of 1%. We got 6% now, and we've got a Congress that won't cut anything.
I hear you.
Yeah.
We've heard you before.
Yeah.
I've heard you for years. And if I'd taken your advice over all these years, I would have missed out on a terrific stock market rally.
Okay, well, look,
wouldn't I?
I'm not in the stock picking or stock recommending
You're
business.
in the stock crash forecasting business.
No, I'm in the fundamental analysis of sound money, of fiscal rectitude, of small government, of free markets, of honest pricing, and we don't have it. This is a bubble.
If I'd have followed your advice, I would have missed it. And I would. I mean,
you would have, and if you would have...
I would have missed a lot of money.
Okay. Let me tell you what you might also miss coming up.
But,
all right?
No. But we constantly get this from big-time bears.
Yeah.
The crash is coming. The crash is coming. We've heard it for years and years and years.
We don't know the exact date.
It's always out there in the future.
But it
and
happens.
You've got to be right, because there will always be some crash of some sort in the future.
It always happens. On March 27th, 2000, the NASDAQ 100 peaked. 15 trading days. That's not very long. 15 trading days later, it was down 33%. They were carrying people off to the morgue financially.
Yeah, but you said the top of the market was in 2015, and it still went up. That's what you were predicting. You said the market topped in 2015, and it didn't.
Okay, but
not okay. No, it's not okay. It's not okay.
Right. I mean, come on.
Look, I am here to tell you that
we're
this
wondering
is
why.
Can I get my point across if you don't mind?
No, let's get our point across when you're wrong.
Speak.
Okay, I'm here to tell you that the central banks of the world have printed massive amounts of money. It's created a bubble in the stock market. They kept printing long beyond any rational expectation of what they could do. And the ECB did, the Bank of Japan did, and so forth. That's what has created the stock market at this level. But it won't stay here because all the central banks finally realize they've gone too far and they're pivoting in the opposite direction.
Last one. Do we get the big sell-off that you are predicting next year?
I think in the coming year, yes, I think we do.
In the coming year?
I think we do.
That's tied you down to a time frame.
Okay, good.
Okay.
Okay.
See you later. Thank you very much.